here's kind of this is really a deep dive in terms of Crummy Trust and alternatives and how they work. So maybe we can start with kind of just we'll start with because this category came up is well, let's start with the simplest. We'll go right to left actually. Duration, what does that category mean, Peter, and like why is that important?
Yeah, just saying the duration of the planning structure. So crummy trusts are green because they can last for the kid's entire lifetime. There's no limit. Um, Outright gifts are red because as soon as you transfer the money, it's that's it. It's in the kid's hands. Custodial accounts and 529 plans can last basically until the child's an adult. Eventually, the money is going to come out or be spent. So that's why they're yellow.
Yeah. And just to address kind of, so this question is for all of these options here, um, the all of these structures here are using that same annual exclusion. So to John directly answer, you can't gift $18,000. So if there's a crummy trust, that's set up for Peter, his parents couldn't put $18,000 in that crummy trust for him and directly gift him $18,000 in the same year. Is that right, Peter?
Yeah. So you can't do both. So the way both crummy trusts and direct gifts to beneficiaries work and 529 plans work is that the annual exclusion is per beneficiary. And so you have your kid Tommy. If you make an $18,000 gift to Tommy directly, that's using Tommy's your full annual exclusion with respect to Tommy. And so you can't then make a gift to a 529 plan for Tommy or a crummy trust for Tommy because you've already used Tommy's annual exclusion. What you could do is you could make a $6,000 gift directly to Tommy, $6,000 gift to a crummy trust for Tommy, and a $6,000 gift to a 529 plan for Tommy. But it's cumulatively $18,000 per person per donee.
Yeah. Now, estate tax efficiency is probably potentially one of the most important categories here.
Yeah.
We'll start with like, so what does this at a high level, and correct me if I'm wrong, what this means is how much are you, assuming you're facing or potentially might face the gift and estate tax, really the more efficient, estate tax efficient these strategies are, the more you'll pass on to kids or future generations. Is that fair to say, Peter?
Yeah,
Now,
exactly. Yeah.
now the reason that because this is an important piece, and this goes to kind of Charles, your question. Maybe let's dive into why are crummy trusts so estate tax efficient, Peter.
Yeah. So there's a couple reasons. So one reason is specific to custodial accounts. So custodial accounts, if the custodian dies um, during the during the term of the custodial account before it ends, in some cases the money could be included in the custodian's estate for estate tax purposes. So that's a specific issue having to do with custodial accounts. There's no equivalent issue with crummy trusts. So when you give money to a crummy trust, it's totally outside of your estate, no matter what happens. So that's sort of one advantage, but more big picture in general, crummy trusts allow the donor to pay the trust taxes. So that essentially the trust is disregarded for income tax purposes, typically, but not for estate and gift tax purposes. So to answer this, also goes back to John Busco's question. So crummy trust is generally disregarded for income tax purposes, but not for other purposes. And so, yeah. So what happens is, let's say you have,
And just by
$2
the way,
million
I
in a
just want to
crummy
point out
trust.
this is a really just important and big piece as to you can gift assets to the crummy trust, put them outside of your estate, and so what that means is if you gift $18,000 and that grows to $50,000 over 20 years, that appreciation doesn't count as being inside of your estate. and won't use up any of your exclusions, or you won't face any gift and estate taxes. Once you gift the
Yeah.
assets outside of your estate, all the growth is estate tax free. But you can pay the taxes on whether it's yield, dividends, capital gains on the investments inside the Crummy Trust. And so this is where you have that $18,000 annual exclusion, but because you're paying those taxes, it's almost like that exclusion is higher because you can pay the taxes for the trust and that doesn't count as part of your annual exclusion or lifetime gift exemption. Is that right, Peter?
Yeah. Yeah, exactly. And so it's maybe a little bit counterintuitive, but what happens is, so let's say there's, you've been giving to the Crummey Trust for a long time. It's been generating some sort of investment return. There's $2 million in the Crummey Trust. Um, so at that point, the income taxes on the Crummey Trust are going to be pretty significant. Depending on what you're investing in, you could easily be paying tens of thousands of dollars a year in income tax on the Crummey Trust behalf. But because you're technically liable for the trust income taxes, the IRS doesn't consider that a gift. It's a non-gift. So essentially, you could keep making your $18,000 or $36,000 gifts to that Crummy Trust, and you can pay the $40,000 or $50,000 a year of income tax liability that the trust is incurring. And so essentially, you're getting your annual exclusion gift, and you're getting to pay the trust taxes without using any lifetime gift tax exclusion. And so you might actually be transferring the equivalent of $100,000 a year to the trust instead of 36,000.
Yeah. And just to even add on, so that's a big, like you transfer $18,000. Then on this $2 million portfolio, there's $50,000 of taxes that you can pay. And in part one is it's reducing your estate, the value of the assets you have in your estate, which means in the future, you're less likely to face estate taxes. But even potentially just as importantly, it means the trust keeps that $50,000, which it gets to reinvest and grow. So there's one part is you reduce your estate, which means less future estate taxes, but then also your children or grandkids or whoever is a beneficiary of that Crummy Trust, it means the trust gets to keep that money and create more wealth for them. And that's
Yeah,
kind of it's the double win there.
and so to more directly address Charles's question about so the donor could pay the income tax on the distributions for the kids. So what it is this is only while the money's inside of the trust. So distributions from the Crummy Trust to the kids, as long as the trust is set up the way that Crummy Trusts are typically set up, which is as what's called grantor trusts, which are disregarded for income tax purposes. The distributions aren't taxable, and so you could distribute, the entire amount if you wanted to from the Crummy Trust to the kids, and that wouldn't be income to the kids, and it wouldn't be income to the grantor either. The distribution would be disregarded, but as long as the money is inside of the trust and hasn't been distributed, you would be paying the taxes on the capital gains, on the interest income, the dividend income, whatever it is.
Yeah. And now just to kind of, so this is why it's like by far and away, crummy trusts are the most kind of impactful for, again, for estate tax efficiency beyond funding your kids or grandkids' educational expenses. Now, move on to creditor protection. We briefly mentioned this before. Peter, just want to give kind of a quick synopsis of what that is and, why crummy trusts and 529 plans are stronger in this area.
Yeah, so there's two big concerns that people have around asset protection, basically. So one of the big concerns is just that you or your kid, whoever the beneficiary is going to get sued by somebody for some reason. Maybe they're a doctor and they have a malpractice lawsuit. Maybe they get in a car crash or something, or somebody falls on their property. So, one thing a Crummy Trust does is it shields the money both from the donor's creditors and also from the beneficiary's creditors. So as long as the money is in the trust, that nobody's going to be able to come after that money unless they have some claim against the trust itself, which is highly unlikely.
Yeah.
Um,
Yeah. And Yeah, I was
And the
just
other thing is, a common thing that we see is kids get married. The parent or grandparent is at least a little bit concerned about a possible future divorce. Um, and one of the nice things about irrevocable trust in general, including Crummey Trust, is the assets inside of the trust are clearly not the spouse's property. And so if they get divorced, that spouse isn't going to be able to claim that they own half of the trust. Whereas if you give the kid money directly, they might have a stronger claim that they deserve half of that money.
now we've talked about kind of control last that hey, the reason crummy trusts stand out here is they can beyond once a person becomes an adult, they can these crummy trusts can still keep going. While custodial accounts and 529 plans kind of end then and outright gifts, you give control once you gift it to them. Now, fees, maybe you just want to talk about kind of really it's just, outright gifts, custodial accounts, they're simple 529 plans are simple, low cost. Cheap, they are cheaper than crummy trusts. I'll just call out. So one of the big advantages of Valor is we can help you set up a crummy trust at no cost today, and our fees are a fraction of kind of what the industry is. But just to be candid, it is still significantly more expensive. $1,000 a year for the crummy trust, which is more expensive than these other options. So it does really make sense if you're putting more into the trust versus, again, most of these other things are for smaller amounts, but they are cheaper in that regard.
Yeah.
Uh,
Yeah.
now, there's, go ahead.
I was going to say the one thing I would say is, if you contribute every year to a Crummey trust, after a few years, there'll be over $1 million in the trust, at which point the $1,000 a year for administration becomes pretty small, almost negligible. But yeah, Monty's right that, an outright gift obviously is free. And so this is a little bit more expensive.
Yeah, and that's what's like. I mean, I think the easiest way to think about this, right, is like for estate tax, like the outright gifts and custodial accounts, as we mentioned. This is if you're just really giving kind of small one-off amounts to kind of your kids or future generations. 529 plans, you're really limiting it to what do you expect the future value will be to cover educational expenses. Probably trusts are for kind of when you're planning for bigger dollar amounts.